Hello friends. From 1st of October 2025, the rules of futures and options derivatives trading has been changed or modified a little by the Securities and Exchange Board of India, which is the market regulator of the financial markets across the board. Now, unfortunately, a lot of my fellow traders have not understood the exact implications to your trade once these changed rules and regulations have come into effect. Hi, I'm Vijay Bhambwani. I've been trading these markets since 1986 and I focus on bringing to the fore those points that are relevant to real world traders, which are unfortunately not covered by academic outlook and armchair kind of analysis that may be to the point but misses out a few critical points that matter. Now, a reminder, you can view my video in a language of your choice by clicking on the settings button and choosing dubbing in any choice of language that you prefer. Same goes for the subtitles. Let's now dive into the video itself. Now, effective of 1st October 2025, SEBI has made two very important changes to futures and options trading, and these have a huge material impact on your return on investment or ROI. Rule number one, that the way MWPL will be calculated. In this video, previously, I have explained to you why market-wide position limits matter. From a behavioral and a statistical point of view, MWPL has no replacement as a benchmark or a yardstick of greed and fear in the markets. So now SEBI has said, look, we need to change the way you compute MWPL. Earlier, what was done was the exposure taken by traders in the futures and the option segment was put together, and the total exposure allowed by SEBI was known to us. Now, supposing 10 lakh or 1 million lots was the total exposure allowed by SEBI, and you and me as traders have basically initiated exposure to the extent of 5 lakhs, which is 500,000 lots, then MWPL would be 50%. That was pure and simple. There was no confusion, and therefore you could calculate MWPL on your own, which is what I had explained in that video. Now, on 1st October onwards, MWPL will also factor in the exposure taken by traders not only in the futures and options segment but also in the spot segment. Do remember, I have pointed out on my free Telegram channel the hyperlink to everything that I am talking about in this video. As a statistical models trader and a behavioral models trader, I do not make any unsubstantiated statements. Everything that I say, there will be a hyperlink or a previous video in which there will again be hyperlinks to media articles, to other relevant reading or viewing material, and the same are in the description below this video and in the pinned comment below this video. So, SEBI has basically said that we will also be looking at your cash market exposure. Why? Because I have said in my Telegram channel that margin funded trading facility has now come to almost 1 lakh crore rupees, which is 1 trillion rupees. And that is basically telling you that people are not just leveraging in the F&O space, but they are also taking leverage exposure in the delivery space by arranging borrowings from their brokers and paying an interest on it. The system is very simple. You pay 30% upfront, the broker funds you to the extent of 70%, and you pay interest on the amount that you have borrowed. Unfortunately, what happens is that you are making two enemies. If you're not leveraged, only the price is your enemy. But if you are leveraged in the MTF segment, the price and time are your enemy, because the longer the time you stay invested in that stock, the higher amount of interest that you will pay by way of the margin funded trading facility. So now SEBI says we will also look at the cash market. And this rule, which has come on 1st October, will be reviewed every 3 months. Now you would ask me, Vijay, hey, what changes? Nothing really changes for me. I beg to differ. Now, what will happen is that the earlier MWPL, which used to be between 21 to 22% on expiry day, because a lot of contracts used to get squared up, and then slowly rise over the next 3.5 weeks to 38, 39, maybe one off 40% odd, have now crossed the 42% mark on Friday, on the day after expiry itself, on 1st of October. As the chart on your screen tells you, look at how the MWPL is now hit a new high. Why? Because we are now clubbing the cash market exposure as well. Now, here comes the critical aspect that unfortunately no one is talking about. Vijay, why should I calculate MWPL and why does it matter? Because it impacts on how much money you will have to invest. In this video, more than a year ago, I had pointed out to you how much money you really need to begin your life as a professional trader who depends on trading for running your home and hearth expenses. Unfortunately, this expectation of base capital required is often watered down by the unknowing, or maybe the knowing but deliberately watered down because they have a vested interest. I offer no courses, sell no products, so I'd like to put it the way it is. Earlier in that video, I said don't even think about becoming a professional trader unless you have a minimum of 25 to 35 lakh rupees. And do remember, I told you that on 1st October 2024, rules that would be coming into effect will demand 5-10 lakhs more. Now with this new law coming in, you will need approximately 40 to 50 lakh rupees to start a professional trading business where you will run your house and your family expenses purely on trading alone. I'm not talking of investing, I'm talking of trading. Now the reason is something that I'm coming to you. Take a look at this graph, at this picture on your screen. The hyperlink to this is also shared in the pinned comment and the description below this video. This is a screenshot from the National Stock Exchange. It is the additional surveillance margins that kick into the place once MWPL crosses a certain threshold. Now, you not only pay span margin, which is the initial deposit money that you have to enter, you have to pay to the broker before you enter into a trade, either when buying or selling futures or when writing options. When you're buying an option, you're only paying a premium. But when you're writing an option, span margins come in. So in addition to span margin, there is also something called an exposure margin and a concentration margin, in addition to which there is an ELM, extreme loss margin. So the more the volatility, the more the exchange says volatility being higher, we assume that risk to a trader has gone up and therefore we will collect extreme loss margin. Now what happens is up to 70% of MWPL, the ELM is kept constant. Once MWPL goes up between 70 to 75%, ELM goes up by 50%. Between 75 to 80% MWPL, ELM is simply doubled. Between 80 to 85%, ELM is raised by 150%. Between 85 to 90%, ELM becomes 200%. And 90% and above, the extreme loss margin or the ELM goes to 300%. Now, you would have understood why I told you MWPL is so important. Think of a scenario. You enter a trade in the futures or you've written an option. You have a capital of 20 lakh rupees. You've basically exhausted, say, 18.5, 19 lakh rupees by way of initial margins and entered into a trade. You've kept a lakh and a half as spare money. Or when you entered into the trade, the MWPL was 69%. So no additional margins. But on the very next day, the MWPL climbs to 72%. Hey, your ELMs have gone up by 50%. Your broker will tell you, unless you put this extra deposit into my bank account before the trading hours begin on the next day, my risk management and surveillance system, which is software controlled, it's automatic, will square up your transaction as soon as the market opens. You will be kicked out of a trade. Unfortunately, it could also happen when your trade is a loss-making one. You're waiting for it to turn into a profit, but you're being booted out because you ran out of money. Sounds familiar? It's happened to a lot of traders, including myself, in the initial part of my trading career. Earlier, I would leverage myself completely and not keep spare money. Now I've aged and with age have become wiser. I look at all the rules and regulations, plan my finances accordingly, and which is why I'm telling you that your requirement of capital has suddenly gone up, which means the yield or the profit that you will earn on your trades will remain constant. They'll remain unchanged or maybe lower. I'll explain to you why lower. But the amount of capital that you need to put in has simply gone up, which means your net return on investment will come down. Challenge level 1. Challenge level 2. There has been a tweak in the options premium tick size also. Now earlier, SEBI said that if an underlying security is basically priced up to 250 rupees, the tick size, which is the difference between the buy order limit and the sell order limit of a buyer and a seller respectively, should be 1 paise. So there could be a buyer at 99 paise and a seller at 1 rupee, round figure, difference being 1 paise. The minute the security price goes above 250 rupees, the tick price will become 5 paise. Why is this important? Because the tick, the difference between the bid and the offer, is a direct cost to a trader. The bigger the spread between the buy and the sell limit orders or the spread, the smaller is your take home pay. All right, that's a direct cost. So now SEBI has said not only in the cash segment and in the futures segment, but even in the options premium segment, when the underlying is below 250 rupees, the option premium will be quoted on your trading terminal screen in multiples of 1 paise differential or tick price. Now you would be scratching your head. How does it make a difference to me? Wait a minute. You've heard of high frequency traders. Have you heard of algorithmic trading? Have you heard of artificial intelligence? Now these AI based traders, for example, Jane Street, they deploy algorithmic trades where they flip their trades in very small price differentials. They rotate their money 100, 200, 5,000 times. For example, Jim Simmons, who was running the Renaissance Fund, he's deceased, of course, he said we could sometimes do 250,000 trades in a day, collecting pennies on each and every trade, and therefore, at the end of the day, collect a huge sum of money. This will benefit the artificial intelligence and the high frequency trading desks like Jane Street and institutional traders, whereas we as retail traders will not be able to match up the speed and the brokerage enjoyed by these guys, because our brokerage costs tend to be heavy. So the more you flip your trade around, the more STT, GST and other stamp duties, SEBI turnover tax, etc. you and I will be paying. Now this is challenge level number 2, and which means that net, number 1, due to higher MWPL computation, your margin goes up. Challenge number 2, because of the reduction in the spread, you're basically going to see smaller price moves, which means our take home profit will also possibly get compressed. Is there a way out? Yes, there is a way out. Statistics always provides an answer. It is not an easy way out. You will have to trade smarter. Your entry and exits will have to be more and more fine-tuned. You will have to spend more time in analyzing the market and retweaking your statistical trading models that you are making in-house, which will basically negate some of these effects. I'm not saying that you will continue to enjoy the same level of return. There will, of course, be a certain amount of difference, but it is possible to blunt the blow to a certain extent, which is what we are all endeavoring to do through our exchanges and interactions through my videos on my social media posts, especially my Telegram channel, where I share the maximum amount of my research, thoughts, and views on the markets. Friends, I hope my video has made some things clearer to you and it helps you in your journey as a trader. Do remember, I do not charge any paid services. I don't offer any kind of products or services or mentorship programs, etc. There are a lot of fake profiles on social media using my photographs offering commercial services. Stay away from these scamsters. I do not charge anything at all. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how my videos help you become a better trader and on what next topic would you want me to record another video. I thank you for your patience in being with me in this video. Till we meet in my next, this is Vijay Bhambwani signing off for now. Wish you have a very, very profitable day ahead. Take care. Bye-bye.